Did you know that 95% of stock market investors lose money due to simple, avoidable mistakes? Shocking, isn't it? We live in an era where investing has become more accessible than ever before. Yet, the paradox of choice and the complexity of financial markets can lead many astray. The consequences? Significant financial losses. Consider this. A recent study found that the average investor underperformed the market by nearly 2% annually over the past 20 years. That might not seem like a lot, but when compounded over time, we're talking about a significant chunk of potential earnings evaporated into thin air due to avoidable mistakes. And it's not just the novices who slip up. Even seasoned investors can fall prey to common pitfalls. In fact, another study showed that over a 10-year period, almost 80% of professional fund managers failed to beat their benchmark index. That's right, those who make a living from investing often stumble, costing their clients and themselves hefty sums. So, you may wonder, why is this happening? The answer lies in our approach to investing. Many of us dive in without a clear strategy, armed with nothing but a vague understanding of the stock market and a desire to make quick money. We ignore the fundamentals, let emotions guide our decisions, chase past performance, neglect to review our portfolio, and fail to plan for taxes. In short, we commit critical investing mistakes that can be costly. But here's the good news. These mistakes are avoidable. With the right knowledge and strategy, you can sidestep these pitfalls and maximize your return on investment. That's why we're here today. We're going to delve into the 5 investing mistakes you should never make. We'll unpack each one, explain why it's detrimental, and most importantly, how you can avoid it. Knowledge is power, and in the world of investing, it can be the difference between financial prosperity and financial ruin. So, what are these catastrophic mistakes and how can you avoid them? Stay tuned to find out. The first major mistake investors make is ignoring the basics. Sounds simple, right? But you'd be surprised at how many people overlook this crucial step. Imagine setting out on a cross-country road trip without a map, or attempting to bake a cake without a recipe. The end result would likely be less than satisfactory. The same concept applies to the world of investing. Diving into the stock market without a solid understanding of basic investment principles is akin to navigating uncharted waters without a compass. It's risky, unpredictable, and can lead to financial disaster. Let's break it down. First, we have diversification. This is the practice of spreading your investments across different types of assets to reduce risk. Think of it as not putting all your eggs in one basket. If one sector of the market takes a hit, your entire portfolio won't suffer. Next up, risk management. This is all about understanding the potential downsides of your investments and finding ways to mitigate those risks. It's not about avoiding risk altogether, but rather managing it in a way that aligns with your financial goals and risk tolerance. Lastly, we have long-term investing. The stock market is not a get-rich-quick scheme. It's a tool for building wealth over time. Patience is key here. It's about riding out the ups and downs of the market and resisting the urge to make rash decisions based on short-term fluctuations. These principles may seem basic, but they form the foundation of a sound investment strategy. Ignoring them would be like trying to build a house without laying the groundwork first. Sure, you might be able to erect a structure, but it won't be stable or sustainable. So before you dive into the deep end of the investment pool, take the time to understand these basics. Read up on them, ask questions, and perhaps most importantly, apply them to your investment strategy. Remember, ignoring the basics can lead to disastrous financial consequences. Don't be that investor who skips the fundamentals and ends up paying the price. The basics are there for a reason, and they're there to guide you towards a successful investing journey. Mistake number 2 is letting emotions guide your investment decisions. We've all felt the rush of excitement when an investment soars or the pit of despair when one plummets. It's a roller coaster of emotions, and it's easy to get swept up in the ride. But here's the thing, allowing these feelings to direct your investment moves is a one-way ticket to financial turbulence. Fear and greed are the 2 main culprits that can cloud your judgment. Let's start with fear. It's that sinking feeling when the market takes a nosedive and your first instinct is to sell, sell, sell. But remember, the market has its ups and downs, and panic selling can lock in losses and miss potential rebounds. Then there's greed. It's that exhilarating sensation when you see a stock skyrocketing and you can't help but want a piece of the action, even if the price has already spiked. But remember, what goes up must come down. Chasing after a hot stock is like trying to catch a falling knife. You might get lucky once or twice, but eventually, you're going to get cut. So, how can you prevent these emotions from hijacking your investment decisions? It all comes down to discipline and a solid investment strategy. Do your research. Understand the company you're investing in, its fundamentals, its growth prospects. Don't just follow the herd or react to the latest headlines. Think long-term. Investing isn't about making a quick buck, it's about building wealth over time. So don't sweat the short-term fluctuations. Stay the course and keep your eyes on your long-term goals. Also, consider diversifying your portfolio. It's an effective way to spread risk and can help smooth out the emotional ups and downs. In short, don't let your heart rule your head when it comes to investing. Keep your emotions in check, make informed decisions based on facts and research, and stay disciplined. Don't let your emotions dictate your investments. Let facts and research guide you. The third investment blunder is neglecting to regularly review your portfolio. Now, this mistake is akin to setting a ship to sail and never checking its course. You wouldn't do that with a ship, so why do it with your investments? Investing isn't a one-time activity, it's an ongoing process that requires regular attention and care. Just like a gardener tends to their plants, you need to nurture your investments. Regular portfolio reviews are a crucial part of this process. So, what does a portfolio review entail? It's basically a health checkup for your investments. You assess if your portfolio is still in line with your investment goals. Have your financial goals changed? Maybe you're planning to buy a house or you're nearing retirement. In such cases, you might need to adjust your portfolio accordingly. Another important aspect of a portfolio review is checking if your investments still match your risk tolerance. As we move through different stages of life, our risk tolerance can change. What seemed like a good idea 5 years ago might not be suitable today. Regular reviews help you identify such scenarios and take appropriate action. Now let's talk about rebalancing. Rebalancing is a strategy used to return your portfolio to its original asset allocation. Over time, certain investments in your portfolio may perform better than others. This can shift your asset allocation and increase your exposure to certain risks. Rebalancing helps you manage these risks and keep your portfolio aligned with your investment strategy. Think of rebalancing as a compass. It helps you stay on course even when market conditions change. However, like any compass, it works best when used regularly. In conclusion, neglecting to regularly review your portfolio is like cutting the rudder off your ship. You'll drift aimlessly and might end up somewhere you didn't intend to go. So, make it a habit to review your portfolio regularly. Your portfolio is not a set-it-and-forget-it plan. Regular reviews are crucial. Remember, investing is a journey, and like any journey, it requires regular check-ins to ensure you're on the right path. The fourth mistake is chasing past performance. Picture this. You're at a racetrack, watching the horses gallop by. You see one horse, a previous champion that has consistently outrun the competition. But today, it's having an off day. It's trailing behind, not quite at its usual pace. Would you still bet on it just because it's been a winner in the past? This scenario is not too different from investing in the stock market. Many investors make the mistake of buying stocks based solely on past performance. They see a company that has done well in the past and assume it will continue to do so in the future. But just like our racehorse, a company's past performance is not a guarantee of its future success. The stock market is a forward-looking machine. It prices in all available information, including a company's past performance. But it also considers a whole host of other factors: the state of the economy, the health of the industry, the company's growth prospects, its competitive position, and so much more. That's why thorough research and forward-looking analysis are so crucial. It's not enough to look at a company's track record. You need to understand its business model, its competitive advantage, its growth strategy. You need to evaluate its financial health, scrutinize its management team, and assess the risks it faces. Only then can you make an informed decision about its future prospects. Let's not forget the dangers of recency bias. This is the tendency to think that trends or patterns we observe in the recent past will continue into the future. But the stock market is full of surprises. Today's winners can easily become tomorrow's losers, and vice versa. So, next time you're tempted to chase past performance, remember this. The stock market isn't a racetrack. It's a complex and dynamic ecosystem, where success depends on a multitude of factors, not just past performance. Remember, past performance is not indicative of future results. Last but not least, the fifth mistake is failing to plan for taxes. The taxman's share can take a significant bite out of your investment returns if not properly accounted for. It's not just about how much you earn, but how much you get to keep after taxes. The effect of taxes on investments is often overlooked, yet it can make a world of difference. For instance, certain investments are taxed at different rates. Long-term capital gains, dividends, interest income, they all have unique tax implications. Tax-efficient investing is vital. It involves making investment decisions that can help minimize tax liability and keep more of your earnings in your pocket. This could mean considering tax-advantaged accounts, strategically holding investments to qualify for long-term capital gains, or balancing taxable and tax-efficient investments in your portfolio. Remember, every dollar saved on taxes is another dollar working for you. A smart investor always plans for taxes. Avoiding these common mistakes can put you on the path to investment success. Let's recap. Understanding the basics, not letting emotions guide your decisions, regularly reviewing your portfolio, not chasing past performance, and planning for taxes are all essential steps in the journey towards financial prosperity. Each of these elements play a critical role in building a robust and resilient investment strategy. Remember, knowledge is power. The more you know, the better equipped you are to navigate the complex world of investing. It might seem daunting at first, but with time and practice, you can avoid these pitfalls and set yourself up for a successful financial future. We hope you found this video informative and helpful. If you did, show some love by hitting that like button, subscribing to our channel, and dropping us a comment. Make sure to say, "I subscribed," and we'll do our best to respond. Thank you for watching, and here's to your investment success.